I think I finally had a major breakthrough in trying to understand the whole issue of the repo market and, by extension, the reverse repo blowup that started, a couple months ago when the reverse repos went from $0 to now over 800 billion, approaching 1 trillion. And I have to say, I've had an interest in the repo market since the first, the first repocalypse of, was it September 2019, I believe? And when I saw that huge spike up to 10%, I thought, gee, this is something that's important. I should understand this more. And I tried looking into it then, and I kind of, got the basic idea, but I did not until today fully grasp the the true purpose, or I shouldn't say purpose, the true utility of the repo market and just how much it's used for. I thought of the repo market as just, interbank overnight lending. Oh, this is the banks trying to balance their balance sheet at the end of the day, and make sure they have enough reserves on hand so that they can, meet redemptions from their customers who want to withdraw money from the bank or something like that. I thought of it in very basic commercial bank terms. What I didn't understand is the extent to which the repo market is used by financial institutions, other than just commercial banks, for a wide range of uses, namely to finance leveraged asset purchases. For example, I believe a hedge fund could use the repo market to, say, borrow money to buy junk corporate debt. And they would be borrowing against the value of that corporate debt to make the purchase, which sounds pretty great, right? Oh, you put $0 of your own money down, and you get to buy this asset that has a positive, that yields a positive interest rate around 4 or 5%. And you're doing it at a very, very low interest rate. I think the overnight reserve repo rate, I checked before I did this, is around 6 basis points, and that's annualized, I believe. So for 0.06% interest, you're able to purchase an asset that yields, somewhere in the mid single digits every year. And you say, hey, that sounds pretty great, huh? Pretty good deal. You're able to make that with, probably having very little actual cash on hand. You're able to lever yourself up, let's say 9 to 1. You're able to purchase 10 times the amount of assets that you actually have in underlying capital, let's say. I don't know if that's the case. I'm sure it depends, depending on the institution, how much, how good their credit is, how good of a creditor they are. But needless to say, there are these institutions, these non-bank banks, hedge funds, private equity, all these sorts of financial institutions that are using massive amounts of leverage to make, just to chase yield. Now, because these are overnight loans, that means that they are essentially refinancing the loans that they have on these assets on a daily basis. And so if the value of, let's say, that junk bond, and I'll link to the article because it was finally, I've been trying to read about the repo market for a very long time. There's an article by Jeff Snyder where he makes a very simple example to explain how this works. And the article was invaluable, and he links to a bunch of other stuff that he's written in the article. So I might just link to this one article in the description, but it'll be the first thing, I promise, if you want to read what I'm about to go through. So they have to refinance this, let's say this, I guess I'll use an ETF as an example. Let's say SPHY. That's a junk bond ETF. And if you don't know what that means, don't worry about it too much, but it just means you own a pool of junk bonds, and so you diversify and balance out your risk a little bit by owning a share in a bunch of different bonds instead of buying a single bond. Maybe that would be a little better collateral, and somebody would be more willing to finance that purchase for you. Well, when you're constantly having to refinance every day, you are susceptible to fluctuations in the value of that asset on a daily basis or on whatever the term of the repo is you're doing. I mean, sometimes they do longer than overnight repos, but short term anyway. So whatever the term is on the repo that's being conducted, you're going to be susceptible to changes in whatever the market value for that asset is. And so in order to roll over that position, if let's say the value of the asset goes down, in Jeff's example, he says, okay, let's say the value goes down from 10 to 8. Well, then you have to make up that difference, that $2, either out of your own pocket or by using some other asset that is more valuable as collateral. Because now, since the market value of that asset went down from 10 to 8, they're only going to loan you 8. You know, that's only good enough collateral for them to loan you $8, which is not enough money to pay back your loan from the previous period, which was for $10. So in order to roll over your loan to the next period, you have to pay back that old loan. It's just like if you short sell your house for less than you owe on it. Either you have to make up that difference and pay the bank the rest of what you owe, or the bank has to take a haircut on it. And in the repo market, lenders are not willing to take a haircut. You're going to be the one to take a haircut. And so this is where U.S. Treasuries come in. U.S. Treasuries are, despite what you might think of them long term, if you're someone like me who thinks, well, gee, the debt of the federal government is totally unsustainable. Who would buy a 10-year Treasury bond that's only yielding 1.3%? That's nuts. There's way too much long-term risk. Who knows if in the next 10 years the U.S. will even exist? We could be bankrupt by then. Well, what Jeff's explanation as to why people are willing to pay so much for Treasury bonds that they only yield 1.3% is because the people who are buying them, these institutions who are the major players in the Treasury market, these banks, are not looking at them as long-term assets. They're looking at them as tools of liquidity, as merely assets to use as collateral in a repo. And the reason for that is that treasuries are the most liquid asset in the financial system, in the global financial system. And so overnight, on an overnight basis, or whatever the term of the repo is, the value of that treasury is going to be a lot more stable than whatever the high yield junk asset it is that you own, that you're using to actually make money. Let's say SPHY, that junk bond ETF that I mentioned earlier, I think it's somewhere around $26 right now trading there. Let's say it goes down to $25, and you don't want to take a haircut on that $1 a share. Instead of putting up your shares of SPHY that you want to refinance as the collateral on that loan, you put up some treasury bonds that you have that have maintained their value. And so that way you can ride out that fluctuation, that dip in the price of SPHY, and still collect your yield off of that, because that's the higher yield, but you don't have to take the hit in the price. This is a way of trying to mask the volatility. It's a way of trying to get around some of the pitfalls of buying assets using leverage, because normally when you use leverage to purchase assets, any losses that you incur on that position are going to be paid entirely by you, and none are going to be paid by your creditor. They're not going to loan you $25 for an asset that's only worth $24. And so that's why having an asset like a U.S. Treasury, which has a much more stable value in collateral terms, is worthwhile. It doesn't matter to these people what the yield is on the Treasury bond, because they don't own the Treasury bond for the yield. They own their junk bonds to get the yield on that. That's where they're making their money. Owning a Treasury bond to them is nothing but insurance. And so to whatever money they're losing from the low yield on the Treasury bond, they just look at that as an insurance premium, and they factor that into their calculations and their profit and loss. And so this, to me, finally explains why. And again, I don't know necessarily that I agree with this 100%, but it's as good of an explanation as I've heard as any, because I have not been able to comprehend why, if inflation is as high as it is, why is that not being reflected in bond prices? Why would interest rates not rise to ensure that they're at least staying positive, that that there's a high enough inflation premium to account for the potential that inflation is not transitory? And part one of that answer as to why we seemingly have negative real Treasury yields is that they don't care about the yield. The Treasury bonds, in other words, have additional utility beyond their utility as a debt instrument for an investor to collect interest upon. Now, the second reason why it would make sense, or what would the second explanation as to why we would now have seemingly negative real Treasury yields, meaning Treasury yields that are below the rate of inflation or the rate of expected inflation, when everybody is supposedly expecting inflation to rise. The yields on Treasury bonds would not seem to reflect that, because they're falling, and they are well below 2%, on the 10-year, and everything else. I mean, I think, what do you have to do to get above 2%? And right now, the CPI, I believe, is seems to be on track to be well above 2%. But even the 30-year Treasury is only like 2.3%. And so it seemed like the entire yield curve for the U.S. Treasury market is in negative territory in real terms. And so can it be that the bond market is just too dumb to realize that? Well, no, because something else that Jeff pointed out, I can't remember if it was in this article or not, but I read like 3 of his articles today, and one of them, is this one that finally clicked with me. The banks are the ones who have most of the responsibility for printing money and for creating inflation. As Murray Rothbard used to say, commercial banks print money out of thin air. That's what they do. That's their business model. They just create money out of thin air, and then they lend it to you and collect interest on it. And so the Fed, while they expand the monetary base by printing bank reserves and giving banks the capacity to lend more into the real economy and to create inflation by expanding the real supply of money in the actual economy, not just the supply of money on paper that's sitting in a reserve account at the Fed. And so therefore, if there was going to be a big expansion of the money supply into the real economy, and there was going to be a lot of inflation, the banks would be the first ones to know about it, because the banks create inflation. And if the banks are the biggest players in the Treasury market, and the Treasury market does not reflect very much inflation at all, in fact, it would seem to indicate that there's almost no inflation, well, these would be the guys to know. They would be the first ones to know if there was going to be inflation. So if the Treasury market doesn't reflect that, maybe there's just not going to be any inflation. And you have to be careful in how I word this, because it's very easy to look at the cost of living and say, well, the cost of living is going up. And frankly, that depends on what you're buying, how it's measured, and what sectors you're looking. I mean, there's a lot of variables. I mean, we've had asset price hyperinflation over the last 10 years, but we haven't had hyperinflation in consumer good, in the price of consumer goods. And so what I think I see in the Treasury market, based off of what I feel like I've learned today, because this has all been building for a long time. Like I said, I first started looking into the repo market in 2019. It's just like today I finally had that big epiphany to where I can start figuring out what it all means. What it looks like to me is that the bond market, which is the banks, agree with the Fed that the inflation that we're seeing now is in fact transitory. And what that means is that the banks do not plan on lending out into the real economy in any big way. In fact, a lot of people keep pointing out this story about Wells Fargo closing people's personal lines of credit. Banks do not seem that eager to lend out to real people. That's not how they feel like they're going to make their money in the future. It seems like a deepening of financialization and the creation of more and more derivatives and just creating a deeper and denser web of all of these financial instruments and contracts is how they plan on making their money. Because look at the last 10 years. It's been 13 years now, hasn't it, since 2008. Our economy, the real economy, has not done very well. It hasn't grown very much. But you know what has grown? The financial economy. Finance is where the money is at. And so why would these banks be wanting to, waste their time and resources on investing in that? And so what they want to do is they want to keep leveraging up and filling their balance sheet with, high yield junk assets that can make them, mid to maybe even high single digit returns. And they're going to insure those positions by purchasing Treasury bonds, which again, they don't care about the price, where Treasury bonds are going long term or if the government will ever pay them back. What they care about is having insurance today so that they have collateral for overnight. They're operating under a regime of incredibly high time preference, considering the amount of money they're dealing with. So I hope some of that made sense, and if it didn't, which it probably didn't, read the first article I'm going to link to, and I'm also going to link to a second article that got me started on this rabbit hole yesterday or the day before. It was, a piece in Real Clear Markets. So you're going to see two links, one to Alhambra Investments and one to Real Clear Markets. And hopefully you won't spend 2 years trying to figure this stuff out before it finally clicks like it did for me. Hopefully reading that first article, and if you want, he's going to link through in that a bunch of other different stuff that's really good. You'll understand what Jeff's point is here, which I think is an important one. It's not one that I'm not going to say that I'm a total believer or whatever, because I haven't had enough time to think about it. I only just now wrap my head somewhat around what his point has been for all this time. But it definitely squares some circles that I've been grappling with now for a while. So with that said, I will see you folks back here tomorrow.